We are looking at prices from a world that no longer exists. A world where Iran's supreme leader was still alive. A world where Dubai's airports were operating normally. A world where US military bases had not been hit by ballistic missiles that pierced the most sophisticated air defense systems ever built. That world ended Friday afternoon. But the price didn't update because the exchange was closed. When COMEX opens, it is not reopening into Friday's reality. It is reopening into a new one, and it will not open at $5,278. It will open wherever algorithms, institutions, and physical buyers who have been watching events unfold all weekend collectively decide gold belongs in this environment. If your capital is sitting in a frozen brokerage account, you are not part of that discovery process. You don't shape the opening price. You react to it. Paper silver closed Friday, February 27th at $93.66 bid. Paper gold closed at $5,278.20. Those numbers are now historical artifacts. They reflect a Friday afternoon that the world has already moved beyond. The real question isn't what happened Friday. The real question is what happens when $6,000 gold collides with a futures market that has been frozen for 48 hours while everything changed. Let's be precise. Silver, $93.66 weekly close, a historic print in modern trading history. Gold, $5,278.20, also historic. Now here's the number that matters more than both. The gap between Friday's COMEX close and live weekend trading is roughly $700 per ounce. $700 in a single weekend. While your brokerage app showed a frozen screen, the real world kept moving. And that gap is not going to close by the live market falling back to meet Friday's paper price. The traders paying $6,000 are not irrational. They are simply the only participants pricing real-time risk with current information. They know what happened. They are pricing it. When the paper market opens, it adjusts to them, not the other way around. And this is before the next mechanical force even kicks in. Silver closing at $93 on a weekly basis already triggered breakout signals for systematic momentum funds. The computers were programmed to buy on strength. That programming didn't disappear over the weekend, so now imagine those algorithms firing into a market that already has a $700 gold gap, a geopolitical decapitation event, a major Chinese bank warning of possible gold inventory depletion. That's not noise, that's structure. Now let me be clear, none of this is financial advice. This is analysis based on publicly available information and years of studying precious metals and geopolitical risk. You are responsible for your own decisions. I am not your broker or your financial advisor, but I have watched enough cycles to recognize when something is different. This is different. Before we go further, I want to know where you stand. Are you holding physical metal through this weekend, or are you in cash waiting for a pullback? Comment below. It helps me understand how to frame any emergency update before the open. Now let's talk about gap mechanics, because many people believe they can simply buy Monday morning and participate in the move. That assumption can be very expensive. When COMEX reopens with gold already $700 higher on active markets, the opening print is not a temporary spike. It is not an overshoot. It is the market's official recognition of what gold is worth in the world as it currently exists. The opening price is not the start of the rally. It is the price after the rally already happened while you were locked out. Market makers facing a $700 gap widen spreads to protect themselves. Liquidity thins because sellers have no incentive to part with metal after a weekend of escalation that validated holding it. The structure becomes buyers competing in a thin, wide market. That's not strategic accumulation, that's emotional chasing. Then the short squeeze begins. Every trader who shorted gold at $5,200, $5,300, $5,500, they are already underwater in live markets. Margin calls don't wait for retail convenience. Forced buybacks push price higher. Higher prices trigger more margin calls. More margin calls trigger more buying. This cascade does not pause. It does not negotiate. It does not wait for late entries. And once forced shorts are cleared, discretionary institutional capital looks at the chart and may decide this is the trade of a generation, extending the move again. Most of this process is already in motion. The only question is whether you were positioned before the gap or after it. That choice is not made Monday morning. It was made this weekend. A frozen brokerage screen and Friday's $93.66 paper silver tell you exactly which side you're currently on. I've spent this entire weekend connecting these dots so you don't walk into Monday blind. Because when the open hits, emotion will take over for many investors. Instead of reacting emotionally, I want to show you the pattern that's already unfolded over the last 5 days. 5 days ago, silver was at $94. Iran's nuclear negotiations had just publicly collapsed. What followed was not random, it was sequence. And when you recognize the sequence, what comes next isn't speculation, it's structure. 5 days ago, I told this audience something very specific. The setup for precious metals was the strongest structural configuration I had ever documented. Not because of a prediction, because of structure. Supply deficits were baked in, demand was both industrial and monetary at the same time. And every geopolitical pressure point globally was already stretched to maximum tension. Friday's close confirmed it. Silver, $93.66. Gold, $5,278.20. Historic weekly prints, both of them. Then phase one began. 3 days ago, the United States and Israel launched precision strikes on Iranian military infrastructure, defense ministry facilities, missile sites across Tehran and other major cities. Iran's defense minister was killed in the opening wave. Israel declared a national state of emergency. Citizens were ordered to shelter. U.S. embassies across the Gulf locked down immediately. Within hours, gold on tokenized markets repriced to $5,194. Silver broke through $120 in China. And something critical happened in Shenzhen. Dealers stopped selling physical metal altogether. Not to push price higher, not to speculate. They stopped because they could not confidently name a price at which they were willing to part with physical inventory in an environment they could not assess. That was the first physical paper decoupling of this crisis cycle. The physical market stopped trusting the paper price within hours of the first missile. Then phase two. Iran retaliated, not symbolically, not selectively. Ballistic missiles were launched toward Dubai, Qatar, Bahrain, Kuwait, Riyadh, Abu Dhabi. The Gulf region, the most concentrated intersection of global energy infrastructure and financial capital on Earth, came under simultaneous attack. A U.S. naval base in Bahrain was struck directly. American personnel watched incoming missiles penetrate layered defense systems. Patriot, THAAD, Aegis. The most advanced air defense architecture ever constructed. Multiple interceptions failed. That is not a minor tactical detail. It is a strategic data point. It forces every military planner and every institutional risk desk to reassess what U.S. assets in the region can actually withstand. Then phase three. Iran's supreme leader was killed in a precision strike publicly confirmed by the U.S. president. The compound in Tehran destroyed. Satellite imagery showed total devastation, and the announcement was not framed as a limited exchange. It was positioned as the opening move in a broader regime change posture, an invitation for internal collapse. That is not a contained military strike. That is decapitation. Gold immediately repriced to $6,000 on the only open markets available. At the same time, a major Chinese bank issued a formal notice warning customers that due to extreme volatility and critically low liquidity, it might suspend gold savings operations, buying, selling, physical exchange. Think about that. A commercial bank in the second largest economy in the world telling millions of customers it may not be able to deliver gold because inventory is strained. 3 phases, 3 escalation events. 3 separate moments where the physical market moved ahead of paper and forced repricing. Each phase pushed metals higher than the last. Each phase made de-escalation harder. Each phase lengthened the off-ramp. This is not a chart pattern. It's not RSI. It's not a moving average crossover. It is a 5-day escalation sequence with internal logic. And that logic points directly toward what happens next. A Monday morning open in a world where phase 3 already occurred while paper markets were dark. Every prior phase created a price gap the paper market had to close when it reopened. When gold hit $5,494 in phase 1, paper markets repriced upward. They had no choice. When silver broke $120 in China, futures moved to close the gap. They had no choice. Now gold is trading at $6,000 on live venues. Paper markets have been dark through the entirety of phase 3. They reopen in hours, not days, and they are not reopening at 5,178s. They will reopen wherever collective intelligence, algorithms, institutions, discretionary capital decides gold belongs in a world where Iran's supreme leader is dead. Gulf infrastructure is under missile threat. A Chinese bank warns of depleted gold inventory. Advanced U.S. air defenses failed to intercept incoming missiles. That number is north of $6,000. The only live market on Earth is already signaling that. And silver, with a smaller market, tighter supply, and heavier industrial demand, could experience a percentage move that makes gold's gap look restrained by comparison. Now let's address something the financial media is not explaining correctly: the off-ramp. Every limited military conflict historically includes one: a face-saving exit, a symbolic exchange, back-channel diplomacy, a point where both sides can step back and markets can discount the tension. That's how previous Israel-Iran exchanges ended. Gold spiked, then it retraced. Markets understand that playbook. They price an off-ramp discount into geopolitical spikes, but that playbook depends on leadership structures capable of negotiating. When a nation's supreme leader is assassinated, the negotiating authority is removed. You don't create a demoralized opponent ready for talks. You create a power structure dominated by escalation doctrine. Commanders whose institutional identity is resistance, not compromise. The political layer capable of accepting a ceasefire is gone. What remains are actors structurally incentivized to escalate. When officials who plan these strikes publicly state that consequences may last decades, that is not short-term volatility language. That is structural reset language. And structural geopolitical resets are the environments where precious metals do not spike temporarily. They reprice structurally. This is not a volatility event. It is a regime shift. And in regime shifts, metals don't simply fluctuate. They reset higher. Now here is the number I want you to sit with. Based on Friday's paper close, the gold to silver ratio sat at roughly 56 to 1. That means it took 56 ounces of silver to buy 1 ounce of gold. Historically, during real geopolitical crises, not headlines, not temporary flare-ups, but genuine systemic stress, that ratio does not stay elevated, it compresses. Why? Because silver's market is a fraction of the size of gold's. The entire above-ground investable silver market is smaller than the quarterly revenue of a single major U.S. technology company. That's how small it is. Capital flows that barely register in equity markets can move silver dramatically. Now imagine directing into that tiny market the combined force of institutional safe haven buying, retail panic demand, central bank diversification, ongoing industrial consumption. And here's the critical part. Industrial demand does not pause during war. In many cases, it accelerates. Look at what is currently in the air over the Persian Gulf. Interceptors, cruise missiles, advanced weapons systems. Modern military hardware relies heavily on silver for conductivity, circuitry, sensor systems, and communications infrastructure. Active combat doesn't wait for orderly supply chains. It burns through inventories. That burn rate does not show up in civilian supply projections. Now compress the gold-silver ratio toward 30 to 1, a level historically seen during periods of extreme monetary stress. If gold is $6,000 and the ratio compresses to 30.1, the math places silver at $200 per ounce. That's not a prediction. It's arithmetic. It's what happens when capital floods into a small market already facing supply constraints. And in high-stress environments, timelines compress. Moves that normally take years can unfold in months, sometimes weeks. Now let's address something that may be underappreciated: air defense failure. The United States spends over $800 billion annually on defense. Systems like Patriot, THAAD, and Aegis are designed to project near impenetrable protection over strategic assets. When incoming missiles penetrate those systems, markets do not treat that as a minor tactical detail. They treat it as a capability signal. If advanced defense systems can be challenged, risk models change. Military planning changes. Insurance pricing changes. Political calculations change. And if escalation reaches major naval assets or strategic infrastructure, the response would likely not be measured. It would be overwhelming. When serious policy discussions begin referencing words like tactical nuclear options, markets are no longer pricing a temporary flare-up. They begin pricing a generational shift in geopolitical stability. And in generational shifts, gold does not spike briefly. It reprices structurally. Now let's return to silver, because this is where the distinction matters most. Gold's current crisis is primarily a demand shock. More buyers want it than the market can comfortably supply at current prices. Over time, higher prices can incentivize additional supply and recycling. Silver's situation is different. Silver has the same demand explosion as gold: safe haven flows, institutional allocation, retail demand, but it also entered this crisis with an existing structural supply deficit. Major producing regions have faced disruptions. Inventories available for delivery against futures contracts have been trending lower. Physical dealers in Asia recently paused sales not because price was wrong, but because inventory was tight. And unlike gold, silver is consumed. It is used in electronics, energy systems, manufacturing, defense applications. Once used, much of it does not return to the market in easily recoverable form. There is no strategic silver reserve equivalent that can be released to calm markets. There is no coordinated global body that can rapidly increase silver production. New mine supply takes years, often a decade, from discovery to full output. When you combine inelastic supply, structural deficits, accelerating industrial demand, safe haven capital inflows, there is only one mechanism that restores equilibrium: price. Not commentary, not reassurance, not temporary volatility. Price. And in environments where stress compounds instead of resolves, that adjustment does not happen gradually. It happens abruptly. And the price that ultimately clears this market in the middle of a hot war with fractured supply chains and industrial demand accelerating with every missile launch is nowhere near what the paper market at 93.66 is signaling. So tell me what you're seeing on the ground. What are local dealers quoting right now for a 1 ounce silver coin? How far above spot are private mint rounds trading? What premiums are attached to junk silver bags? Because the premium over the COMEX paper price is the most honest real-time indicator in this entire market. It's the physical world speaking, and often it speaks long before the future's screen catches up. Now let's talk about the economic pressure point. Iran doesn't even need to formally activate to shake the global system. The Strait of Hormuz. Roughly 20% of the world's daily oil supply moves through that narrow corridor. Iran sits directly beside it. They don't need to announce a blockade. They've already demonstrated the capability to threaten regional assets. The moment anti-ship missile risk becomes demonstrable instead of theoretical, insurance markets react. Underwriters stop using peacetime models. They price active missile exposure. And when insurance premiums spike high enough, certain routes become economically non-viable, even if not a single additional tanker is struck. If coverage becomes unaffordable, ships don't sail. That tightens global oil supply. And oil that was already elevated doesn't need a catastrophic event to move toward $150 or even $200 per barrel. It only needs sustained uncertainty in the most critical shipping choke point on Earth. Now consider the position of the Federal Reserve. Before this escalation, it was already cornered. Inflation still running hot. Producer prices above expectations, rate cuts risk reigniting inflation, rate hikes risk breaking a debt market already under stress. Now layer in an oil shock. Oil at $150 filters directly into food prices, transportation, industrial inputs, everything. The Fed can't cut without fueling inflation. It can't hike without risking credit contraction. It becomes reactive instead of proactive. And in a world where the central bank is reduced to reacting, capital looks for money that does not require central bank permission to hold, move, or trust. That is where gold and silver step in. But there's a deeper structural shift underway, one that began accelerating in 2022. When the United States froze a sovereign nation's reserves by leveraging its dominance over global financial messaging systems, every country watching learned the same lesson. Dollar reserves are not neutral. They can be weaponized. The rational response? Reduce dollar dependency. And the first assets sovereign nations reach for when diversifying away from weaponized currency systems are physical gold and silver, assets that cannot be frozen if held domestically. China has been accumulating precious metals indirectly through solar manufacturing, electric vehicle expansion, and large-scale commodity imports. Analysts tracking import flows and refinery throughput suggest official gold reserve figures may understate actual holdings. If accurate, the global reserve balance is shifting faster than headlines suggest. Now connect that to the Gulf. China is also the world's largest oil importer through the Strait of Hormuz. A destabilized Gulf threatens its energy supply chain. A prolonged conflict accelerates the very de-dollarization infrastructure Beijing has been quietly building since 2022. That doesn't create a temporary metals spike. It accelerates a multi-year structural revaluation. And structural shifts don't reverse when a ceasefire is signed. The infrastructure being built to settle trade outside the dollar system doesn't get dismantled because a temporary truce is declared. If anything, each day of conflict strengthens the incentive for non-Western sovereign wealth managers to move faster. Now I want to speak to two groups. First, those already holding physical metal. You prepared for systemic fragility. You recognized that a system built on leveraged paper claims to metal, administered by institutions that can run short on physical inventory over a weekend, has a breaking point. What's happening now is the stress test. The paper market will be volatile. Ceasefire rumors could send gold down $200 in an hour. Social media will declare the top. Hours later, new escalation sends it right back up. War is volatile by nature, but nothing about this weekend weakens the structural case for precious metals. If anything, every missile launch, every supply warning, every oil shipment disruption reinforces it. Trust the thesis. It's being demonstrated in real time. Second, those watching from the sidelines. Those waiting for confirmation, for a pullback, for proof this wasn't noise. Your caution is understandable. But understand this. Structural shifts rarely announce themselves politely. They don't wait for perfect clarity. They unfold unevenly, violently, and then, suddenly, reprice in ways that leave hesitation behind. The only remaining variable isn't direction, it's timeline. And in environments like this, timelines compress faster than anyone expects. Every breakout feels expensive in the moment. Last week, $93 silver felt stretched. That instinct isn't irrational. Wanting a better entry price is human. But here's the real question. At what point does caution turn into risk? When a major Chinese bank publicly warns it may suspend gold trading because physical inventory is running low, when the only open global markets are pricing gold hundreds of dollars above Friday's COMEX close, when an 88 million person nation sees its supreme leader killed in a foreign missile strike and its ambassador delivers a 5-word response at the United Nations, At what exact number does waiting become more dangerous than acting? Gold has functioned as money for over 5,000 years. It doesn't respect market hours. It doesn't pause for the Monday open. It doesn't sit politely at $93 while investors debate whether they're emotionally ready. It trades at whatever the world believes it's worth, right now. And right now, the global pricing signals suggest gold is near $6,000. They suggest silver is meaningfully above 93 ounce. The futures market simply hasn't adjusted yet. Monday morning, it adjusts. The real question isn't whether you agree with the number. It's which side of the repricing you're standing on when it happens. I'll be tracking every development this weekend. Statements out of Tehran, responses from Washington, signals from Beijing, and movements across the Persian Gulf. If anything material changes, a carrier strike, a nuclear signal, a ceasefire breakthrough, I'll issue an emergency update immediately. In an environment like this, time compression is real. An hour of delay can mean a $10 move in silver that never retraces. Speed matters. Also understand something structural about information flow. Precious metals analysis often struggles for visibility during high volatility news cycles. Broad engagement is what ensures critical financial discussions reach investors before markets reopen. Share this analysis with anyone you know who is holding assets inside brokerage accounts and hasn't prepared for a potential gap move. The investors who understand the mechanics behind what's unfolding will make calculated decisions. Those who don't may open their apps Monday morning, see a chart disconnected from Friday's close, and react emotionally. Emotional reactions in a structurally shifting market are how retail investors lose money at the very moment opportunity is presenting itself. Today is Sunday, March 1st, 2026. Gold is trading near $6,000 in open markets. A Chinese bank is signaling possible inventory strain. Regional escalation continues across the Gulf. U.S. air defense credibility is being questioned after failed intercept reports. Paper silver closed Friday at 93.66 in a geopolitical environment that no longer exists. The futures market opens in hours. Be prepared, not emotionally, but structurally.